Okay, hi everyone. So what I'm going to do now is I'm going to provide you with a solution for question 25.5a. This is on cash flow statement. So hopefully by watching this, you would be able to prepare the answers for the other questions. Yeah. All right. So this is the question, okay, which is one of your tutorial question, okay, in OL. So what you see here, the balance sheet is given to you, okay. So by now you would have known how to prepare the cash flow statement and basically what are the contents or what are the items that you'll see in the cash flow statement. So let me just briefly tell you, okay, that cash flow statement is where you would show the movement of cash, whether the cash comes into the business or the cash goes out from the business. So at the end of the cash flow statement, you would be able to see the changes of your bank and cash. Okay, give me a second. Okay, of your bank okay, the one that you see here, from 2019 to 2020, the changes or the difference, as well as if you have a bank overdraft, okay, you would also include that in. So basically you want to show in the cash flow statement that from 2019 to 2020, there's a change in the amount of bank and cash, okay, and the reason of the changes here is because of the movement of cash. Yeah, so the balance sheet here is given to you all. So you can see there's non-current assets, current assets, and then your liabilities, your current liabilities, your non-current liabilities, your capital, your opening capital and your closing capital. So you are asked to draw up a statement of cash flows for the year ending 31st December 2020 using the IAS 7 layout. So you actually have two methods of preparing the cash flow statement. So the one that we're going to use is the indirect method, where it actually uses the IAS 7 layout. Okay, and you are told that fixtures bought in 2020 cost 800, whilst a van was also bought for 11,000, and there were no disposals of non-current assets during the year. Okay, so what I'm going to show is step by step each part of items that you will see in the cash flow statement, and I'm going to show you how to calculate that. Yeah, so this is the solution, the overall solution. So this is statement of cash flow. So you would have operating activities. There are three activities altogether, operating activities. You have investing activities as well as financing activities. Okay, so under operating activities, you would start off your cash flow statement by taking the profit from your SOPL or your SOFP. So you would start off with the net profit from operation. So this 42,320 is actually taken, you go back to the question, from the net profit, okay, from the net profit in 2020. So you see here, there's a net profit of 42,320 here. See that? Because you're preparing the cash flow statement for 2020, so you will start off with the net profit for the year of 2020, which is 42,320. So that you will start off your cash flow statement with that figure there. That is what you see here, 42,320. Okay, next what you need to do is to adjust whatever expenses, okay, or revenue that has been recorded in the SOPL, but it does not involve any cash movement. Like for instance, we have depreciation. Okay, depreciation means that it doesn't involve payment of cash. Depreciation is just merely reducing the value of the non-current assets. That's it. Okay, so it means that depreciation, okay, is not something that you have to pay, right? So in your SOPL, in your income statement, this 42,320 that you get from your income statement, the net profit, the most bottom part, is the amount that you, after you have deducted the depreciation as well. Okay, but since this is a statement of cash flow, as I've mentioned earlier, you would only record those items that involves cash movement. So depreciation doesn't involve cash movement. So therefore, since previously you have deducted the depreciation in your income statement to derive your amount of profit, 42,320, what you need to do now is to add back the depreciation. So you actually add back the depreciation. See that? Previously you have deducted, now you add back since you realize that depreciation does not involve any cash movement. Okay, other than depreciation, you have other things as well. Like for instance, provision for doubtful debts. For this question, there's none. If there is provision for doubtful debts, the increase or decrease in provision for doubtful debts would have been included in your income statement earlier to get this net profit of 42,320, right? But now you would realize that the provision or the increase or decrease in provision for doubtful debts does not involve any cash movement. So therefore, if previously you have deducted the increase of provision for depreciation, provision for doubtful debts, if you have deducted it earlier, then now you have to add back as well. Okay, and if it's a decrease in AFDD or allowance for doubtful debts, then previously you would have added, now you have to minus back. Yeah, but for this question, there's only depreciation involved. Okay, let me go back. Later you'll see when in the next slides, okay, the explanation for this. Yeah, how you actually get the 4,440. Okay, so other than depreciation, AFDD, you also have the profit or loss on disposal. Profit or loss on disposal does not involve any cash movement as well. It's just profit or loss, right? So therefore, you need to make an adjustment for that as well. If it's profit on disposal, you have to minus back because previously you have added on to the profit. If it's loss on disposal, you have to add back. Okay, so that's for the adjustment. And then after that, you would need to check this. The changes, okay, the triangle means is changes in current assets and current liability. So I'm giving you the steps, yeah. The first one is to do the adjustment for non-cash movement, okay, in income statement. Okay, so that's the first thing that you need to look out for. Second is to, under operating activities as well, you have to look at the current asset and current liability that you have in your balance sheet, okay, or SOFP. Look at the changes, whether there's an increase or decrease in your current assets or current liability. Okay, but it would exclude cash and bank. In this part here, you would just leave the cash and bank first. You would ignore it first because cash and bank comes later. So you would only focus on the changes in current assets and current liability. Okay. The third part is the tax paid and the interest paid. So tax paid and interest paid, if there's any, you have to record it here. Okay, cash generated by operations, you minus tax paid and interest paid, but for this question there's none, so you leave it blank. And then you have investing activities. Okay, so for investing activities, you would be referring to your changes in non-current assets for the 2 years. See whether there's an increase or decrease in the non-current assets. It may also be given in the additional information. Yeah. And the fifth one is for financing activities, you would be focusing on the changes in your non-current liabilities as well as your capital. If there's capital introduced, new capital introduced, and also drawings for the year. Okay, so these are the things that you would focus on, or what you look out for in the question. Yeah, so hopefully this is very clear. Yeah, so again, I'm just repeating this. First, to start off with the profit from operation. Okay, this is taken from your SOFP at the net profit part at the bottom. If they give you the SOPL or income statement, then you just take the net profit for the year. Okay, and then you have to adjust for the non-cash movement in income statement. So if there are any revenue or expenses that you would have recorded in the income statement earlier, okay, and you figure out that it's actually non-cash movement, meaning that it doesn't involve any cash payment or cash receipts, then you need to adjust those items. Like for instance, depreciation that we have here, you need to add back to the net profit because depreciation doesn't involve any cash payment. So by right, you are not paying anything. So you have to add back because earlier you have deducted it in your income statement. Yeah. And then next is to look into the changes in current assets or current liability. So look at between the 2 years, whether it has increased or decreased. You would exclude cash and bank in this part. Okay. And then next is the tax paid and interest paid. Next part is for investing. So the top part are all operating activities. So that's why you get net cash from operating activities. Okay. So which is 22972. So this is the net cash from operating activities. So operating means that it has to do with the operation part of the business. And the next activity is investing activities. So investing activities means that investment. So when you say investment, companies would invest in non-current assets. So that's why you'll be focusing on the changes in non-current assets. Okay, whether there's an increase or decrease. So that will determine whether you minus or add. Okay, whether it is inflow or outflow. And lastly would be financing activities. To finance the business is either you borrow money long term, so that is the changes in non-current liabilities, or you introduce more capital into the business, so you have more finance. Okay, and then if you take out money from the business, so that's drawings, that will reduce the financing activities part. So this is the whole cash flow statement. Yeah, so we'll go back to the question, but which I've broken into small parts. Oh yeah, before that, so this is the continuation of the answer earlier. So at the bottom here is the one that you will, this part here, yeah, this and this. Okay, this is once you have added up all the three activities, you will either get a net increase or decrease in cash or cash equivalent. Cash equivalent is referring to bank. Okay, it's equal to cash. Cash is equal to bank. Cash is what you have in your hand. Bank is the cash that you have in the bank account. So they call it as cash and cash equivalent. Okay, so you can either get a positive or negative amount depending on whether there's inflow or outflow. Right? So in this case, it's a net decrease because it's a negative amount. So to prove this is where it's like magic. Yeah, it's magic. Okay, so there's a decrease of 2028. Okay, which later I'm going to show you step by steps. But to prove that there's a decrease of 2028, you can prove it by checking the opening balance of your cash and bank. Okay, this is actually referring to the opening balance. Again, I will explain on this, and then compare that with the closing balance of your cash and bank. So meaning that you are referring to the 2 years. Look at the changes of the 2 years and see whether is it the same as the changes or the net decrease or increase that you receive here. So I will show it to you later in a minute. Right? So now I'll go into each of the elements. We'll look at the first part of your statement of cash flow. Just now I've shown you the full answer of your cash flow statement. So I've broken it up. So let me explain to you how, okay, just now I've explained to you the 42,320 is taken from the income statement, right? Okay, so the adjustments depreciation, remember I've shown earlier, you have to add back because it doesn't involve any cash payment. How do they actually get this depreciation here? So different question, you will have different ways to calculate. But if you understand how it works, then you should be able to find the answer. Yeah. So let's look at the question. So I've actually taken some parts of the balance sheet here, which involves depreciation. Okay. So what they have given here is they did not give you the amount of accumulated depreciation or depreciation for the year. Instead, they have given you the net book value because they have stated here, like buildings, there's no depreciation, yeah? So it's 100,000, 100,000. But fixtures, they have less accumulated depreciation, van, they have less accumulated depreciation. Which means that this actually represents the net book value. Okay, if you can recall what you've learned last semester, net book value is the amount of cost minus the accumulated depreciation, right? So, you have at the beginning of the year, meaning that it's 2019, okay, and then end of 2019 and end of 2020. So you need to compare the two. But before you do that, you look at the bottom part here. You are told that fixtures bought is 800 for the year, and they bought also a van for 11,000 for the year. And there were no disposals of non-current assets during the year. So in order for you to find the depreciation figure for the year, okay, for 2020, for fixtures, okay, you would just take the net book value for fixtures from 2019, which is 3,600. And then they bought new fixtures. So you add on the new fixtures, the new cost of fixtures. So this will give you 4,400. Okay, 4,400. Yeah. Okay. And then you have for 2020, the amount is 4,000. So this is for 2019. For 2020, it's 4,000. So which means that there's a decrease by 400. So the decrease by 400 would actually be your depreciation for fixtures. Oops, okay, depreciation for fixtures. So that's how they get the depreciation for fixtures 400 here. Okay, so same goes for van. You do the same thing. So for van, it's the van less accumulated depreciation is 7,840. Sorry, my bad handwriting. Okay, and then they bought a new van, 11,000. So you just add on the new van that they have just bought. So there will be a total of 18,840. So this is for 2019. Okay, for 2020, the value reduced to 14,800. So when you minus it out, you'll get 4,040, which is the amount of depreciation here. So the 404,040 is actually the depreciation for the year for fixtures and van. So it's by taking the net book value, because this question only gave you that, right? The information. Net book value from last year plus whatever cost that they have just bought, compare with the value in 2020. The difference will give you the depreciation for the year. So you'll get a total of 4,440 that you need to add back to the net profit. Okay, so hope that is clear to everyone. Yeah. Okay, next is we've done the first part. Okay, now we're going to the next part, which is the changes in, this is the changes in current assets and current liability. Okay, so that's why they call it as movement in working capital. Working capital is for current assets and current liability. So you go back to the question, the balance sheet, which I've shown here in blue here, yeah, this part here. Oops, okay, this part here. Okay, so this is taken from the question. So you need to compare 2019 and 2020. This is 2019. This is 2020. Right? So look at inventory. There's an increase of inventory from 2019 to 2020. From 11,200 to 24,800. So there's a difference of 13,600 that you get here. Right? It increases in inventory. So you need to ask yourself, when your inventory increase, it means what? It means that you purchase more inventory, right? So when you purchase more inventory, your money goes in or goes out? Is that an inflow or outflow? So ask that. So when you buy inventories, definitely your money goes up, right? So there's an increase in inventory, which actually what happened is there's an outflow of cash. So if there's an outflow of cash, you have to put a bracket because it means that you minus out your cash. Okay. Next is accounts receivable. There's an increase from 12,800 to 16,400. Again, ask yourself, when there's an increase of 3,000, there's an increase of 3,600, right? Okay. So this means what? When there is an increase in accounts receivable, it means that there are more people who owes you money, right? Because there are more debtors now. There are more people not paying you up. So, which means that in the form of cash, there's a cash outflow because you don't receive cash. Okay, so you minus out as well. And then bank and cash, as I've mentioned earlier, you would ignore it at this part. You only look at bank and cash later, at the most bottom. Next is to look at your accounts payable. So accounts payable is current liability. There's an increase of 6,588, which is here. So you have to ask yourself again, when there's, oh no, not an increase, there's a decrease. Okay, there's a decrease. Oops, sorry. Okay, there's a decrease from 12,600 to 6,012. So there's a decrease of 6,588. So ask yourself, when there's a decrease in accounts payable, it means that accounts payable are the creditors that you need to pay to. So if there's a decrease in accounts payable, which it means that you have already paid them. That's why there's a decrease in accounts payable. So therefore, it's cash outflow. So you put a bracket. You minus out. Yeah. And bank overdraft, you would ignore that as well. You will only use this later, this information later. So this is where you would actually need to look at the changes in your current assets and current liabilities. Yeah. So this part here. So we'll move on to the next part. Okay, just now we had the tax paid and interest paid, but as I've mentioned, there's none in the question. So you would just you still need to put it in, just put a dash beside it. Okay. But if there is a tax paid and interest paid, then you have to show it. Yeah. Next is calculation of investing activities. So just now we've looked at operating activities. Next, for investing activities, these are the changes in non-current asset. So for this question, they have given you the information at the bottom. Okay, the additional information where they state that fixtures bought 800, van bought for 11,000. So you know there's an increase in fixtures and van, or increase in non-current assets, a total of 11,800, meaning that they purchased more fixtures, they purchased more van. There were no disposal, so they didn't sell any non-current assets. Okay, so they didn't receive any money for the sales of non-current asset. They only purchased. So the 11,800 has to be deducted because it means that there's a cash outflow. When it's cash outflow, you minus. Your cash goes out from the business. So this is what I mean by changes in non-current assets for investing activities. Yeah. Lastly is your financing activities. So financing activities, there's 3 here in the question. So as I mentioned, financing activities would be referring to the changes in non-current liability, okay, as well as capital and drawings. Look out for these three. So non-current liabilities, here you have only one here, from 20,000 to 30,000, increase of loan repayable in 10 years. Oops. Okay, so increase of 10,000, okay, as what you can see here, it means that you borrow more money. When you borrow more money, what happens to cash? Your cash increase, right? So that's why you plus. You don't put a bracket. Yeah, you add the loan received. There's no other non-current liability, so that's done. Next is capital. Look at your capital. Don't look at the opening capital, yeah? You look at the cash introduced, if there's any. Oops. So in this case here, let me move it. Okay. Cash introduced, they introduced 20,000 of cash in 2020. So your cash increase. Sorry, they introduced more capital, yeah? So your cash increase. And drawings, you don't compare the 2 years. Instead, you just take the drawings for the year, which is 43,200, which reduces your cash because you draw out money from the business. So that's what you would record in your financing activities, right? Okay. And yeah, this is the last slide. So just now I've also mentioned this. At the end, you'll either get a net increase or net decrease when you add up all that, the operating, the financing, and the investing activities. So here there's a net decrease of 2028. Now to prove it, you go and look at your 2019 bank and cash. So 2019, you have a total of 2240, which is this. This is the beginning of the year. Okay, beginning of 2020. At the end of the year, okay, so if you take the net decrease, you plus the opening balance, okay, of cash and bank, you'll get a difference of 212. Okay, this 212 would actually be the total cash and bank for 2020, the closing balance, right? Because when you say there's a net decrease, it means that previously you have 2240 of cash and bank. So if there's a decrease in cash by 2028, you minus it out, you'll get 212. That's what it means. Yeah, because there's a net decrease in cash. So you have to reduce the opening cash and bank. So check whether this is correct. So how to check it? You have to look at the total cash and bank here in 2020. So in 2020, they have a bank overdraft instead of bank. Okay, so when you add it up, you have to take 400 cash minus 188 bank overdraft, because bank overdraft is something that you owe to the bank. So you have to minus, you cannot add. So 400 minus 188, you actually get 212, which is the same as your 212, the amount that you get when you take the net decrease plus the opening balance. It must be the same. It must be the same. Yeah. So basically, when you prepare the cash flow statement, it's actually explaining to you what happened to the cash and bank amount. Okay. You can see that there's a difference or there's an increase of cash and bank by 212. But where does this 212 comes from? So the 212 comes from the operating, investing, and financing activities, and that is actually shown in the cash flow statement. Yeah. So I really hope this is clear to you all. If not, you can always rewatch it again. And again, as usual, I always tell you to reach out to me if you still have problem. You can come to me and yeah, I'm not supposed to use the P word. Yeah, just tell me which part don't you understand so that I can explain to you again. Yeah. So thank you so much, and hope this helps. if anything, just write in your feedback in OL, so that I know which part you are not getting, so that I'll be able maybe to prepare more, you know, either notes or video to help you out. Yeah, thank you so much.